Okay, so today I'm gonna basically just simply go over what I've been doing recently to basically, hedge a little bit though, because obviously the so-called, market feels a little jittery, although, like I said, and historically speaking, September has been a little bit of a rockier month for a lot of tradings. Doesn't necessarily mean that this September is going to be that way either, though. So obviously, I always tell people though, whatever happens in the past is the past. The present performance is what it is. You cannot really guess where the market's going to be and stuff, but it does feel like it is a little bit sensitive right now. Yeah. So what I've been basically doing is doing basically broken wing butterflies. Now, just a show of hands though, are you guys familiar with basically like ratio spreads, front ratio spreads, like in particular?
I'm somewhat familiar with it from
somewhat familiar. Okay, let's go over it very, very quickly, so that way you guys can actually understand where I'm coming from. So that way, because like I said though, it's way easier to do this in video than basically trying to explain it though. So
this was in your last video, right? That you recorded.
I actually, so the last video I actually did the so-called back it was basically a back butterfly, basically. It was not actually a front butterfly. So it's a little bit different in what it is, though. So everybody can see my screen right now, currently? Okay. Yep. So let's just go to SPX. I have a lot of positions on it, though, but let's just clear all of this out. This was chaotic. Okay.
So Rob, I got a quick question for you.
Sure.
So it's okay to be negative almost 10K BP and you'll be fine?
So this is due to the so-called the so-called after market futures requirement though. Yeah. So as long as if you're negative here though, what you need to look at is your maintenance excess. Okay. If this is negative, then you're going to be on what is known as a futures margin. Well, a futures call. It's not a margin call though. And basically what they want you to do is they want you to close the futures to basically have this thing. But this is perfectly fine. This just means that I cannot trade anything after hours right now because obviously there's no.
I gotta check mine because I'm currently negative 15K on that.
That's okay. It's fine. I mean, it's fine if the so-called thing has to also do with you hedging the so-called portfolio too. Okay. Many times, if it's due to a hedge, it's okay. If it's directional, like if you're in the hole, whatever 15 or not in the hole, but I mean if you're in the negative and then your so-called portfolio's delta is just through the roof and stuff like that, though, they may actually close it by themselves for you. So it just depends on how much risk they see that you're taking, based on the portfolio. But many times though, I've been actually even this part negative, but it's due to the fact that I'm only negative here because I basically shorted the so-called futures to hedge my portfolio. They didn't give a crap. They just left it alone and stuff because they know it's basically negatively it's oppositely correlated to basically what my portfolio is going to do in the morning. But yes, this is perfectly fine though. Just make sure that if you're going to be in a negative though, make sure that your maintenance excess is still in the positive. You don't want this thing to be negative. Otherwise, well, what will happen first is that they're going to issue you the so-called futures margin. So you have to close off the positions to bring this back.
Yeah, or the next negative.
Yeah. Or the next day, this basically, they're not going to give you the so-called intraday futures margin until basically you close it all up and it will be active that following business day afterwards. So that's another thing to kind of keep in mind though. You would lose your futures intraday margining until basically this becomes positive again.
I had that happen one time already.
But it's okay though. It's not a big deal or anything. Okay. So in any case though, so a so-called ratio spread, or at least a front ratio spread, is just simply selling a so-called, well, it's a combination of a debit spread and a short option attached over it. So for example, let's just say that I want to ratio this SPX right now though. So I can sell the so-called 445 puts, right? And I can buy the so-called 4450s. Now, this is basically a put debit spread. Now, if I add one extra so-called short option onto it, this becomes a ratio right now. So in this own so-called position, when you look at the so-called curve, if you guys can see it, let me bring it a little closer. There you go. So this is basically what a ratio spread is. So basically you have an extra short option right here now. And now basically, you know, the stock can basically stay, basically, obviously it can go bullish, it can stay still. But if it starts approaching like, you know, your short strikes, basically you have this actual even more so-called profit potential because that's the one so-called debit spread that's embedded into this trade. Does that kind of make sense to you guys, so to speak? So so in other words, if I basically take this and brought this down to 1 right now, so if I took this down to 1, this is your put debit spreads. This is directionally bearish, but because you're adding 1 extra so-called put, so you're collecting an extra additional 1760 in premium, you're actually collecting a credit for this entire thing. And it's basically has a higher probability of success than just simply selling the put by itself. But you typically only do a ratio spread for certain reasons. Basically, because the max profit is when it actually starts to approach this so-called short strike right over here. You know, you kind of want to kind of anticipate it to kind of, you know, move towards your way, but not too far, so that way you're in the red. Now, if it does go in the red, though, the benefit of it is that you can actually take assignment and extreme so-called discount because this put spread is deep in the money and it's giving you an extreme, like, you know, discount to whatever this so-called strike is, basically towards your break even and whatnot. Okay, so the reason why I want to bring what a so-called ratio spread is that a broken wing butterfly is simply the risk-defined version of this ratio spread. So what does that mean? So to risk define this right here has basically not unlimited risk, but obviously if it goes to 0, you're going to eat it very, very hard. So obviously, how do you risk define this part? You obviously buy another so-called long option on the so-called wing part. So if I bought this, if I go back to the so-called table and I just hypothetically, you know, bought this right over here, then you go to the curve. Oops, sorry, wrong side.
They might arrive early, just so you know.
Are they going to arrive early? Oh, okay. There you go. So now this becomes basically risk defined, if you guys can see that, because of this long so-called long option I bought right over here, right? So again, same exact premise. You know, if it stays, you know, still, or you know, basically you just collect the so-called premium from this 85 cents. If it were to go right near the so-called short strikes here, you can get a basically like your maximal profit, which is very difficult to do. But you know, nonetheless, though, this is the reason why, you know, it's attractive, because you can make money if the stock stays still, goes up, and even if it starts going against you, you know, you're kind of welcoming it to kind of go into this so-called peak zone right over here. Though, in a normal regular butterfly, the so-called wings are equidistant from each other, right? So if you did this, this is an regular ordinary, you know, long butterfly, essentially. But because you're breaking the wings, hence this is your so-called broken wing butterfly. So the distance between the so-called one side is basically different than the distance from this side. So here you have 10 points wide, here you have 5 points wide over here. And again, if I took this off, this is your so-called ratio spread, right? So hence, that's what the so-called, so that's my idea of why I want to just, you know, reiterate what a so-called, you know, ratio spread was. The broken wing butterfly is simply the risk-defined version of this so-called ratio spread. Now, when we're talking about hedging, obviously, I don't want to be on the put side, because the put side is basically more towards the bullish side. So what I want to focus on is basically going so-called towards the so-called call side. So I will sell the so-called, I'll sell the call basically, and I'll buy one right here. I'll sell two by one. Okay, so this is your call ratio spread right here. So you can see that if the stock, you know, continues to basically stay downwards this way, you're good. You know, you'll basically get this entire thing. If it starts to approach upwards this way, then of course, you know, you can actually get more money. But if it starts moving way too far upwards, then obviously you're going to be seen at a loss though. So again, to basically define the risk, you can just simply buy one of these, and oops, I always get the ratios wrong. So basically this side has to be longer than the other side, basically. Yeah, there you go. So however much you want to basically make the so-called length is really solely up to you though. But what I've been basically doing is that, I would basically sell one of these, and it doesn't really use up that much so-called buying power and whatnot, because obviously you're defining the so-called risk though. And what I'm doing is I'm doing something known as laddering. And what laddering is that basically I am actually adding these on at different so-called expirations, only basically like a week apart from each other. Now, the main one that I basically started, so if this is going to look kind of like a cluster, but okay, I have a lot. You can see like this is a lot on the so-called position itself. So let me see if I can, okay, so let me take this off first. Okay, my current position right now looks really like messed up because obviously, I have a lot of layers on top of it. So this is how my, this is pretty disastrous right here. But if you really break it down though, you can look at all the so-called expiration periods that I have though, all right? So we have 1 day. So actually the 1 day to expiration right now, I did this yesterday though. This is just a very, very cheap iron butterfly that I basically decided to just put on just in case, just in case SPX were to just kind of go up though. So, and this one I paid only like $1.44. So I just figured, I was like, you know what though, let me just see if it wants to rally upwards this way. So this is like kind of like tomorrow's 0 day to expiration kind of play, before the bell, right? So this one you can kind of ignore though, but this other one, so I'm going to take this one off. But the main one that I started doing, if you guys can see 6 days from now, this one I did approximately 3 weeks ago, right? I basically sold, hold on, is that right? 6 days expiration, yes. Okay, there you go. Okay. There you go. So I basically sold this, broken wing call butterfly essentially 3 weeks ago. Now, 3 weeks ago, the so-called market was a lot higher than it is now, though. So what I did was I basically did this thing actually in the money, believe it or not. So just like, as an example, if I was going to put this like a brand new hedge like today, right? Let's just say that I just want to protect my so-called, assets right now. Let me see. Yeah, okay. Take all these out. Okay, I would go about 3 weeks, give or take, to like a month, just depending on like, what your so-called, time horizon is in terms of the market, wanting to tank down. But let's just say that I decide to just do a little bit of protection from the 22nd of October. Right now, SPX is at 44.93 right now though. So I would actually go very, very close to the money if I wanted to basically put on the so-called trade. So hold up, can I take this off? How do I, why is this thing all like on right now? I'm trying to remove everything. Yeah, here you go. Let's take that out. Whoops. What, did I send this in? That's weird. No. Huh. I'm just wondering why that's not going away. Delete the leg, delete the leg, delete the leg. Oh no, sorry, this is my current position. That's why. I'm sorry. I'm dumb. Okay, sorry. Let's go to a different expiration then, just in case. Okay, let's just say I'm starting the so-called position right now, the hedge position. And let's just say that, you know what though, I'm worried that, it may dip even lower though. So I'm gonna likely go at the money. Oh, is he right here?
Yeah.
Hold up, let me see if what I can do. I would sell.
海拔，你先帮我抬到这里，走吧。那个爸。
guys right now. This is all weird now. I wish SPX was not like filled with anything right now. That way it makes things so much easier. Okay, do I have? Okay. And then I go here. And let's switch this to 2. So now, okay. All right, there you go. Okay, so right now, this is basically the so-called hedge that I would put on right now. So this is actually deep in the money already, and this is basically me anticipating that this thing's gonna dip downwards. Now, what I would typically do is that basically I would go to the next week. So let's just say that, you know, this week basically passes by and whatnot, you know, and this thing still stays kind of within the range. I would go to next week afterwards. So right now I'm basically short the so-called 44.95s. So next week, if I decide to basically reopen another position, I would basically probably raise the so-called short strikes higher and whatnot. So as you keep raising the so-called short strikes higher, you're basically bringing back this so-called break-even point even further and further backwards this way, if that makes sense to you guys. So let's just, for example, say that I decide to do this for this week. It's like, you know, major hedge and whatnot, though hopefully I'll get the so-called direction right. And then basically, I will probably, let's just say that I'll sell the 45.05s right now. I'll go to 45.05. I'll buy one of the 45. Oops. Oh, they're not going to let me put this in because it's. Oh, they're not going to let me put this in.
Where's the?
What do you need? The keys? Oh, it's on the table right there. Sorry about that. So 2.
接下来就叫他上来。哦，你在这边看着，我跟他一起上来。
Does that actually show? Damn it, it's not showing, right? Okay, that's that one. This one, they're not gonna let me put it in. Let me see if there's an easier way to show this for you guys. Hold up, sorry about that. I actually never showed this as an example. Do you guys kind of get what I'm doing though?
Yeah.
You kind of do? Okay. Maybe if I dissected my position first. Yeah.
I just have a question for so you're talking about after you open October 15 one, then you want to open so after like a week you want to open
another one that's further outwards, so it's further out of the money.
October 15 one before you open that, or you just open it?
Yeah. Well, so what you want to do is you're basically, you don't need to close necessarily the October 15th one yet until you're kind of confident that the so-called hedge itself is basically done its job already, right? So for example, when I'm doing this other one, so here, this is my current, this one I initially started. I wish I could bring this thing further for you guys. There. Okay, this is the one I initially started. Okay, so it looks like this, right? Your typical broken wing butterfly. Right now, obviously, it's actually gone my way and whatnot, though. So obviously, if this thing expires completely worthless and keeps on going down this way, though, you can see my P&L at expiration is about $1,040 right now, though. And this is 2 of them, so this is a 2x4, so 2, 4, and 2. You can go 1, 2, and 1, depending on what it is, but it's always going to be in that same ratio, or 3, 6, and 3, or 4, 8, and 4. Right? So, okay, so this one I'm just leaving alone because this one's completely out of the money. So there's no real reason for myself to actually even remotely, you know, touch this right now. You know, let the time decay this part away though. Then afterwards, what I did was, you can see, so September 15th, I decided to go open an October 1st one, right? And basically, I decided to go further out and whatnot. So my 2 center strikes is at 45.30. Here you can see my center strike is at 45.20. So I'm raising the so-called center strike. So now we have something that looks more like this, and it looks kind of weird, but now you can see now my break-even point, because I'm basically layering it, is actually way further out this way, right now, though. It goes all the way up to like 40, 45, 37, almost nearly like 45, 38. Oh, actually it is. It's like 45, 39, you know? So, and that's because I'm like layering the whole, like, you know, parts of this to basically, you know, create this. And if for some odd reason, you know, SPX decides to want to rally upwards, that's perfectly fine, because now it's going to be into a higher profit zone when you see these peaks right here. And obviously the most money I'll make is when if it decides to pin at 45.30. But because basically I have this thing layered on top, though, I have a big range of basically where this thing can be profitable. So right now it's perfectly fine if it stays and does what it wants to do. It can come upwards this way. The only thing that's going to screw me is if SPX decides to really run all the way high. But if you really look at it, though, you know, it's risk defined already, right? And you know, I already know that basically how much at the worst case scenario, I'm going to basically, you know, lose if SPX were to blow extreme, you know, go completely parabolic essentially. And hopefully if it does go parabolic and breach this, the rest of your positions will rise in value because of that. Okay. So hopefully, does that kind of hopefully, you know, make sense to you guys?
Yeah.
Yeah.
Okay. It makes sense to you. I know. Anybody who has any questions currently regarding how to basically place the so-called, you know, hedge on?
Rob, earlier
Yeah.
when you saw the two calls,
Yep.
and you bought the call that's a little bit further up, and then you bought another call that's a little bit lower.
Yep.
That's in case if S&P shoots up. Or...
Yes, correct. Shoots upwards. So again, like I said, though, this is a risk-defined version of the so-called ratio spread, right? So if we basically look at this as being basically, let me take this all out. Okay. If we look at this thing simply as being a simple ratio spread, you could see that the so-called risk is to the upside for any ratio in general. I mean, it's just basically if I decide to just simply buy one and then sell two of these right here. Sorry, that is going to go like that. Is that right? Why does it look like that? Oh yeah, there you go. Sorry, I always get that thing. Wait, what? Oh, SPX is probably not the best thing for me to do this on, since do I have a position on SPY? Maybe that's a better. I actually don't even remember what oh no, I don't have a position on SPY. Okay, let's do SPY since I have too many positions on SPX. That's going to just like screw it. Here you go. Okay. Buy one and then sell two. Here. Yep. This is basically what the so-called ratio spread is basically. Why does it look like that? Oh yeah, there you go. Sorry, I flipped it around. Okay, yeah, this is like I said though, this is the ratio spread, right? But of course, you know, your risk is obviously if the thing starts to keep going higher, this is unlimited officially because the calls, this is basically due to the extra short call that's embedded into this. A short call by definition is undefined risk, right? So this is the reason why you basically want to purchase a wing for it, is the thing to basically define the risk. And also at the same time though, be more capital efficient, because if I want to just simply do this, you can see that it's going to cost me 8,722, and this is only on SPY. It's not on SPX, right? SPX is 5 times the size of SPY. So presumably speaking, if I want to do this on SPX, this is going to cost me about $40,000 to basically place on and whatnot. But by me simply buying an extra so-called, you know, wing right over here, I have defined my risk. Oops, again, I screw it up always. There you go.
Oh, 58 on.
Yeah, here you go. And you can see, yeah, because the maximum, because think about it this way. This right here is a debit spread. You know how much you have to pay for it, right? It's the width of the so-called width of the spread minus whatever the so-called premium that's collected in the so-called short one. This is a call debit spread, and then this part is a call credit spread. So you're adding a debit spread and a credit spread together, but they're not equidistant, right? That's the big difference. That's why it's a broken wing butterfly. If they were equidistant to each other, then you just have a regular butterfly just like this. This is an ordinary butterfly. It acts identically the same as the iron butterfly. The only difference between the long butterfly and an iron butterfly is that in this one, you pay the risk outright right in the front right now. So you're gonna pay $29, and then if it comes into the center right here, then it starts to gain value. But you already are paying for your risk, right? Because the maximum loss is you cannot lose more than whatever you paid for this amount of money. And an iron butterfly, you collect the credit first, and then you pay the risk afterwards if it were to go outside. But they're identically the same thing. There's absolutely no difference between a long butterfly versus an iron butterfly. But when you break the wings, like I said, though, when you have a not so equidistant wing, then you have basically, like I said, the so-called call debit spread, which benefits obviously if the so-called stock were to penetrate inwards, because call debit spreads are directionally bullish. But then you have a so-called credit spread right here, which you're collecting in premium. So ultimately, in the end, when you're doing this type of so-called trades, though, you always are going to collect a credit, for it anyway. I mean, that's really the idea of doing it. And you have a very high probability of success when you do these broken wing butterflies. The only drawback is when you buy this, you actually really paying a lot of money to basically define your risk. But hence, that's the reason, you're using a lot less buying power, effectively by doing that. So that's, to answer your question, that's the reason why we want to buy this particular wing, is to define our risk. I have no problem actually doing like, doing like a put so-called ratio spread. But like on a call ratio spread, again, though, this is basically you almost having like a short position at the market, though, just by simply selling the so-called naked call. The additional naked call that's inside of it is going to expose you to unlimited risk. So this is something that you kind of want to just, avoid, to try to expose yourself to if you can, though. I mean, later on, like I said, though, there are ways that you can easily, again, later on, define your risk. I mean, let's just say that, SPY decides to go up and it's around here and you're like sweating bullets. And you're like, well, what the hell do I do? Well, what you can do is obviously you can buy another long one to define your risk. The only problem with you buying this is that obviously you probably are going to take a loss by buying this so-called whatever strikes outwards you want to do to basically define the risk. So by the time the stock is like here, whatever call that you buy here is going to be pretty expensive, if that makes sense to you. So that's the reason why if you define your risk early on and you already know basically your position and whatnot, though, you don't have to like, get into one of this type of like, mitigations of trying to basically, essentially like, figure how to basically get out of, a naked call that's been basically tested. But again, I mean, another aspect of, again, having naked options too is the benefit is obviously you can roll these. You can roll these basically essentially forever for credit, assuming that, obviously, the thing doesn't keep on going parabolic on you like a GameStop. So you don't want to do any kind of naked calls on GameStop type meme stocks. If you're going to do it on SPY, it's not actually that dangerous because in reality, though, it doesn't really move that much. I mean, they move. On average, a large move is any move that's over basically, $2 for SPY itself. And for SPX, any move that's over $10 is essentially a pretty large move in general, on a daily and stuff. So, hopefully that kind of, gives you guys an idea of basically another idea of how to basically hedge your portfolio. Because the reason why I like to do this is that I'm collecting credit and premium. And at the same time, if it were to go against me, I can still have that so-called possibility to make even more money, so I don't have that fear that, okay, well, if I just simply sell for example, just a simple call credit spread and decides to breach my, short strike. Well, if it breaches my short strike, then basically I'm out the spread, basically. There's no real extra, thing that can really get me out of it, unless if like obviously it drops past the so-called short strike. But because you're doing a butterfly, you can actually make even more money if the so-called short strike is breached just ever so slightly.
So Rob,
yeah.
So with the broken wing butterfly that you show with the 4 legs, right? If if the SPY decides to go down, we still okay, right?
Yes, correct. So if you don't know how to set up the so-called butterfly, by the way, though, you can just go to the so-called strategies portion up here on the Tastyworks platform, or Thinkorswim, I think also has something similar to this though. But what you're going to do is you're going to go with a long call butterfly if you're going to go towards the bearish side. If you can switch this to long put butterfly if you want to go bullish. But if you go long call butterfly, they'll bring up basically 3. So a butterfly is basically not 4. It's actually 3 positions. It's 1, 2, and 1, and it's in ratio. So if you want to do 2 of this will become 2, 4, and 2, basically, in quantity. And of course, when you look at the curve, this is equidistance in the butterfly. To break the wings is you basically moving one side, so that way, in this example, you now have basically a bias, essentially. Now you basically just need it can stay still, or it can just go down and you'll be perfectly fine. So it can go down to infinity. But of course, it's defined too. This won't protect you that much though. If you look at the profit and loss at expiration though, this is only a $44 win, if the thing, were to expire. So $44 is not really gonna hedge your portfolio that much, I would imagine. Well, it depends on obviously how much money you have though, but presumably speaking, if you have a 5 or 6 figure type of an account though, you'll have to utilize something a little bit larger. So hence that's why I would go to SPX over SPY. Because of course at the same time though, SPX also has the tax benefit too. You have tax benefits when you trade indexes over the so-called ETF itself. So, I can go long call butterfly, right over here. Same thing, I can go to the curve. Sorry. Again, turn off every other position that I have in this right over here. There you go. Yep, so this is equidistance. So let's just break a wing right there, and there you go. That's what you have. So as long as you can make the strikes any as wide as you want, or as narrow as you want though. If you wanted to go more out of the money, you definitely can. The only difference is that the credit that you're collecting right now initially is going to be obviously less the more out of the money you go. So hence, this is the reason why I always like to start this so-called position out that's actually more deeper in the money. So for example, if I was going to start this position out, the long dated position to truly hedge myself. Now this is only if I'm really anticipating that it's actually going to potentially go down and stuff. So if right now, if SPX at 44.93, I'm like, you know what though, I'm a little worried that it may start to go down. So maybe I'll choose the center strike at 44.80. So here you can see that if SPX still stays still, actually this is still a little bit profitable. It's still in the green zone. But if it starts going downwards, you can start seeing that actually I can catch actually all of this action over here, to the center strike, almost at $1,700. And if it were to keep on going down, I'm capped at about $1,260 basically. And if you look at this position right here, because it's deep in the money, I'm basically, my buying power effect is only $740. So I'm basically, using $740 of buying power effect basically, and I'm collecting $1,260 of premium essentially. So, this is the reason, this is the way I would start it off. And then the week afterwards, I may open another one at maybe at 44.90, and same thing, equidistance and so on. And I'm just going to keep on stacking it and stacking it and stacking it until I'm pretty much confident that, the SPX has kind of stabilized itself. It hasn't, it's not going to go kind of stupid on me. Of course, you don't know, unfortunately. But even today, I looked at the so-called, chart of basically what happened. And, you know, what did, yeah, so here in Hawaii, it opens at like 3:30, you know, everything's going all good, you know, and then all of a sudden it's doing this still. So I'm guessing that, Kyle, you sent the text when it did this, right at this point, right over here, where it did this large freaking, like, you know, cliff dive of like redness right over here. And you're like, what the hell happened? And right over here, it just kind of looked like it just traded pretty much sideways. It looks like you had a little bit of a bounce, but definitely not back to the levels right back to where it started. So it's kind of doing this weird little thing. I don't know. It might be grinding a little bit lower and whatnot, though. But again, when you do something like this, like a butterfly, you know, it's not really too bad of a, like I said, a proposition to try, because again, you're not really risking too much money to try to basically protect a decent amount. But again, you only want to really do this to just basically, you know, as a hedge, you know.
Right. So Rob, so if you wanted to hedge, right, if your account is like a decent size account, you would just increase the quantity of the
Correct. You would increase the quantity to. So here's the thing about like I like to go with the 15% rule. 15% meaning like usually on a true huge correction, right? You have to think to yourself, okay, well, your account may swing at usually about 15%. Now, if your account is super risky, it can definitely swing harder than 15% on a daily. But on average, though, you know, an account that has good, decent diversity, at a worst case scenario could swing basically up to 10 to 15% a day. So you kind of want to, you know, utilize and figure out like how much hedging do you truly want to, you know, use in your so-called, you know, account. You don't want to overly hedge, because obviously if you overly hedge, then you're basically going to chew into any kind of potential profits should the market shoot upward. So it's all about finding the right balance. Everybody has a different balance, by the way, because obviously everybody's portfolio is basically different from each other, though. Right now, you know, my portfolio is just very barely positive. Basically, it's basically it's neutral to basically delta long right now, though. I'm actually trying to get this the beta weighted delta closer to 0, or at least, you know, even towards like the negative early on. So earlier on, Kyle, when you said, oh, you know, F, you know, freaking like what the hell happened and whatnot. Actually, my delta was actually negative because actually I had another position on as well, though, but I actually just closed it, though. So after me closing that position, that's why it turned positive. I will probably bring this to 0 to even just a little bit negative, because again, I'm feeling a little bit more rockier, you know, in terms of how the market's going to do right now. Also, because the VIX is relatively low right now, it's rising a little bit, but it's not completely you know, up there. You know, it's at 1880 right now. I always tell people, you know, when you're trying to sell naked options to just try to, like, you know, collect raw premium and everything, it's one, okay, if you're okay with getting assigned, then you don't need to really worry about this, though. But there's some people who just like sell things just to collect the premium and try to like exit early to just basically lock in profits. If you're doing this when the VIX is under 20, then you have a risk of basically getting margin called if the so-called volatility rises, because what happens is that basically, even though your position looks good, it's out of the money, the premiums of the actual position starts to rise, and it inflates exponentially when the so-called volatility rises. So when I look at, you know, the VIX under 20, I don't do too many naked positions as I would versus when it's over 20. When it's over 20, you get a very, very high premiums collected, and generally speaking, it's going to contract with each other. If it's under 20, I would sell more spreads versus just simply keeping something naked and whatnot. So because the extra so-called protection that you buy is worth it in case, you know, volatility was just going to completely like explode onto you, and it just catches you off guard. Because again, a lot of, even during the so-called March crash, and I'm not saying that we're going to have another one of those, you know, lots of my positions that were really out of the money, I mean, I'm telling you, like, they were really super out of money, just basically, you know, became so inflated in the premium price that actually I got margin called, and I was actually forced to close positions that were really out of the money for losses, and that absolutely sucks to do, you know. So when you have a spread, at least you're protected by the so-called long option. Now, some people will even do things. Now, this sometimes it makes sense and sometimes it doesn't make sense. But some people, let me see, what's a good stock to do this on? Let's just say IBM. I don't have a position on IBM, but let's just say that you want to just simply sell like just this naked put right here for $785 of like premium and whatnot. People you can go synthetically naked by basically buying a very, very far out of the money position like this, and when you do this is almost nearly synthetically naked when you really think about it, because obviously this part is so far out of the money and you don't have to pay that much so-called oh, sorry, hold up, I completely reversed it. There you go. Yeah, something like this is so far out of the money that basically it's almost synthetically like that, as if this is just like here, and this basically is not existent. You don't want to pay that much money, because right here you're paying $1.82. You're collecting $1.82 for this. If you bought protection that's very close by, you're paying a huge amount. So here in this example, $1.82 down to 103, you're almost paying like $80 of protection. But if you go further out, you can almost be basically synthetically naked when you do this. Now, the reason why I say, it depends on the so-called cost effective. Right here, nakedly, this thing will cost, your buying power effect is about $2,500. So you don't really want to make this thing wider. You don't want to have this spread cost more than whatever you can sell this thing nakedly. So that's also another thing to just kind of keep in mind. So if you're going to buy outwards, as long as it's under 24, so this is 28, I wouldn't do that. Yeah, here, 23. So still less money than me selling this thing solely naked. And it only cost me like, maybe the mid price here is maybe 15 cents, So just in case volatility decides to explode outwards, you have a tiny bit of protection just with this, long so-called option. So hopefully that also can help you guys. Once the VIX gets over the $20 range, man, like nakeds are great because you're collecting so much premium and whatnot. But before, when the VIX was like around like 15, 14 and stuff, right now, if you sold something like nakedly, and the thing basically expanded, it would basically probably still show that it's at slightly loss right now, I would imagine. And if it inflates like 3 times or 4 times, though, you'll definitely be showing a deeper loss. And depending on what you're margining available in your account, though, you could actually be at a margin call before you actually know it. So that's also something just to keep in mind. Just the 2 cents. I know a lot of people would never mention this type of stuff to a lot of people because most people don't like to pay attention to the VIX. But the VIX tells you literally what the market sentiment is. The fear index. How much people are nervous about the market itself. So when you look at the VIX and it's elevated, that's the time where you can pile hard on so-called naked options. When it's under 20, it's approaching 20, so I'm okay with putting a little bit of naked options into my portfolio, but I don't want to trade as much as it used to be when it was in its 30s or in its even like mid 20s and everything. So hopefully that also helps you guys. Any questions that I lost you at, or I think you guys hopefully understood what I was trying to.
No, it's great.
Yeah.
I think adding that deep in the money put leg.
Long put. Yeah, the put leg. Yeah.
The long put. Yeah.
Yeah, the long put. Adding the deep in the money long put protects you. Obviously, you're not hoping that it's going to go deep in the money, but just in case it does, there you go. You have that extra protection. Right there. So sometimes it's worth it to buy that extra wing and everything. Now, in terms of right now, what my positions are in terms of like hedging the portfolio is concerned, I'm basically short the Russell's 2000. I'm basically short like half contracts, and I'm also short a little bit of the so-called Nasdaq, and I'm also I'm long the Dow because I want a little bit of positivity to kind of offset too much of the so-called like negative things. But also what's another interesting play is that because I'm short this though, I'm actually also short the volatility. So when you're short volatility, volatility is basically inverse of the market. When the market goes down, volatility rises. When the market starts rising, going higher, volatility goes down and contracts though. So right now I have a weird mixture and concoction of being basically short the volatility, which means I'm bullish the market, but at the same time, you know, I'm also shorting the so-called the Russell 2000. The Russell 2000, I have a lot of small cap stocks in my portfolio, so therefore, you know, this impacts my portfolio greater than me using the Nasdaq currently at its moment. Though maybe tomorrow, you know, when it opens, though, I might short like a very small amount of the so-called mini S&P 500s just to, you know, see, just to get this more, you know, down to like, I want this thing down to closer to like 0 at the moment. Once I know, like, you know, the market has kind of like, okay, you know, the coast is kind of clear though, then I'll start increasing the so-called delta exposure and whatnot. But right now, for the time being, when the market's kind of jittery and whatnot, staying kind of like 0 to like a little bit of negative delta is perfectly fine, actually. In many cases, it's safer to do that and just basically sell more basically premium and just let the theta decay away as being like the main part of your so-called profit making versus like, you know, having like equities increase in price, you know, because when you're at the mercy of equities increasing in price, then you're just at the mercy of what the market wants to do. And it's very, very difficult. When the VIX is extremely low, you know, all I can basically recommend to a lot of people is just basically find, you know, stocks that have looked like they're overextended and just look for call credit spreads to basically sell. So you're adding negative delta. You're adding bearish positions that are out of the money that can still potentially make money as long as it stays like, you know, below the strike price. But at the same time though, if the market does pull back, those will, and the so-called volatility inflates, so those will all be, you know, in the profit zone while you're long. It will basically offset some of the losses that you'll take from any positions that you're long at. So, you know, that's my advice for like, you know, you guys. Hopefully, you know, you guys have been doing okay this year so far. You know, we've had like crazy bullish moves, you know, and making all-time highs. So I hope like, you know, you guys were able to basically take advantage of it. You know, right now, you know, I started this year off early on, I think in three months into the year, January, February. So in March of this year and whatnot, I was around like, you know, 40% profitable. You know, you can see P&L year to date. And I started in the beginning of the year with about 100K and whatnot. I withdrew close to about 40K out of the account already by now. But yeah, I mean, I was already up 40% in the first 3 months, and I'm kind of scratching my head a little bit because I'm thinking to myself, I'm like, wow, that is like really not typical. You know, I mean, that's like almost like that's it almost felt too good and too easy and whatnot. So of course the problem is that, you know, being greedy and everything, I just kept my deltas, like my delta was high. My delta was around like, I think 700, sometimes it would go to like over 1,000, believe it or not, like beta weighted deltas. And during, I think one of my worst months was like, I think May and July. You know, if this P&L fell back down to around like the 20K range, which is still up 20%, but you know, I basically gave back more than basically 50% of what I basically had occurred in, you know, the first 3 months. And if you really, you know, want to, you know, come up with like a solid trading plan, the whole reason why we trade is to just make a better return than what a bank would give to you. My track record in the past and whatnot, though, on average has been approximately 20 to 30%, you know, at the best case scenario yearly. So now that I'm at, you know, over 40%, you know, in profit, I'm actually already, you know, asking myself, you know, how much more can I possibly juice for the rest of the year? So sometimes you have to think to yourself, be like, well, you know what though? If you're already satisfied with your gains, which is kind of hard to be though, you know, it would just help that you just basically bring this delta to basically neutral and just let let most of the so-called profit come in from basically time decay versus you needing the market to move directionally to actually start making money. You may not make as much, in comparison. So like, days like today, being up like around like 2,600 bucks, I've had days obviously when I had like, positive deltas and stuff like that, though, being up like, 8,000 and like sometimes 10,000 a day. But then of course, the big problem is that, it could swing the opposite way, too. Now, this in comparison, the only reason why it's up this amount is actually because of the so-called broken wing butterflies that I had, and also the so-called hedgings that I had early on. So if you look at I had the closed positions right here, though. This I basically shorted early on, like a little bit after I basically woke up. I saw myself. I was already up like around like a little bit over 2K, and I was like, well, you know what though? Let me just try to lock in this profit, if you will. So I just shorted the full contract of the so-called Russells. And of course, in the midst of that, it actually fell down. It actually, fell down completely. So I basically protected myself from $580 worth of decline, by simply shorting the so-called full contract of that. But, for the most part, all the rest of the positions that I had basically, just kind of worked in its own favor. Eventually, the Russells actually did bounce back, actually. I think the Russells was the only index that was actually in the green today. So, hence that also helped my portfolio, because my portfolio has a pretty strong correlation to the Russells itself. But if your portfolio is correlated to like the SP, like the S&P 500 or the NASDAQ, then obviously you would be shorting. It would just benefit you in general, just to short whatever index that's correlated to your own deal. But yeah, I mean, for the most part, I would just say, once you're satisfied, or at least you're satisfied with your profit and loss for the year and whatnot, though, go a little bit more cautious when, pushing forward, and the great part about like, trading futures is that you can simply turn your portfolio instantaneously from neutral to negative to positive just in just one click and everything. So right now, although all of my positions are basically neutralized, though, if I feel that, okay, the coast is clear, I don't need to change anything that I do. I can just simply long, like, the futures contracts, and then that's it. I just call it a day. If the so-called S&P 500 does reach, whatever, 4,700, by the year end, then we'll be all golden. But if it doesn't, then it won't hurt the portfolio as much to just basically keep it completely neutral, and then decide, how much, you're willing to basically risk to basically, go bullish. So for example, if I was gonna just say that, call a bullish sign right now, I would just be like, all right, well, maybe I'll risk 2% of my entire portfolio to basically do that. So I'll put a stop loss at $2,000 and just let the thing run and just leave it alone. If the thing runs, let it run to the moon. If it doesn't run and it hits my stop loss at 2,000, then all right, well, I lost my 2% that I was willing to basically risk that the market was going to go higher, and just call it quits from that point forward, and just like I would just leave my portfolio as neutral as possible until the new year basically starts. So, hopefully, like I said, this helps you guys, understand how to hedge. Any other questions regarding it?
No. Rob, you said that if the VIX is low, it's good to sell put debit spreads on overextended stocks, right?
Sorry. When the VIX is low, you want to sell call credit spreads, meaning, so the reason why the VIX would be low is because the market is high, meaning like it's basically at an all-time highs and whatnot. That means basically everybody's being greedy right now, right? The market's making a lot of money. Everybody's long equities. When you're doing a call credit spread, that puts you in a bearish position, meaning like you want the so-called overextended underlyings to basically either stay still or go down, preferably, because if you've already heard the saying, be fearful when everybody's greedy and be greedy when everybody's fearful. You have to kind of put yourself in that type of mentality, because I know that there's a lot of FOMO in the market. Everybody wants to, make that, go for the throat, make a huge amount of money, but people who basically have that type of greed and whatnot, they usually get burned during one correction, because if you know how markets work, they grind higher, but when there is a correction, it falls like a cliff, like it falls extremely steep, you know. So that's how markets react. So you don't want to be caught going too long and then all of a sudden thing just cliff dives on you. You want to make sure that you have just the right balance of, you know, of basically negative deltas, which is like call credit, any kind of bearish position. Like basic call credit spreads are basically like one of the best ones. You can also go call broken wing call butterflies too if you want to do it though. But you want to, like I said though, have a balance between having long and short. You don't have to be like completely negative, but you know, having like a delta, for example, like this beta weighted delta right now, it basically says that, you know, for an account that's this large though, it's very, very small. That just basically means that for every dollar the SPY goes up, my portfolio is perceived to basically increase by about $154 right now, right? So $154 of basically a six-figure account is basically like less than a percent. It's a fraction of a percent, you know, in terms of movement. So, you know, and likewise, if the SPY basically falls down by $1 though, I should be expected to be losing about $154 based upon this metric. It's not perfect, by the way, because there's a lot of other so-called factors in. If you're more diversified though, it might not even affect you at all, you know, especially if you're in other things like energy that typically like to go higher or typically like to react on its own mind, completely separate from the market. Then I mean, this metric may not even be that accurate for you. But generally speaking though, if you do have a reasonably diversified portfolio though, and you get this thing to zero, if you got this thing to zero and then the market declines, you should not really be seeing too much of a move in your entire portfolio. Your portfolio should not be swinging like 10%, for example, if your delta is at zero. You know, it should be expected to be moving like maybe at a fraction of that, you know, maybe less than 1%. But the more delta exposure positive that you have, obviously that means that you need the market to go higher, you know, for it to basically be affected. It's just basically a good measurement of risk, basically, of how much your so-called portfolio is basically taking on. And like I said, depending on how large your portfolio is, this delta metric is going to be different for you. Like this right now at 154 with a six-figure account, this would be basically being neutral, essentially. It's very minor. It's for me to actually be mildly bullish, this would probably have to be around like $300 to $400 for every movement would be mildly bullish, because that's still less than 1%. That's like 0.5% movement for each point that it moves. And if I'm actually bullish, then this thing would likely be closer to like around like the 800 to 1,000 range if I'm bullish. And same thing likewise, if it's negative, that's how bearish I am. For me, I like I said though, keep it closer to like the zero to like, even for me, staying a little bit negative right now feels just right, because, you know, lots of things are at all-time highs right now. And I just feel that the market's on like thin ice. It just feels very fragile, you know, because quick question. Does anybody know why the market decided to take a dump earlier on? Because I woke up a little bit too late, so I don't know. Yeah, I have no clue what
on anything on the news or anything like that. The only thing I'm suspecting is just some sell-offs.
Okay, I mean, yeah, it could be that too. But like I said though, here's the interesting part, right? The minute the market sees like a candle that goes red like this, like this, it looks like a whole herd of sheep all follow it. They look at this, oh shit, start selling. So it's like everybody just wants to dump. And it could be, like I said, this could just be all algorithmically driven, because a lot of, you know, positions nowadays are just basically being controlled by algorithms nowadays. But it could just set off a whole, you know, basically like can of worms essentially. And eventually when the market starts to like recoup itself, you know, it starts to bounce back a little bit. When were you so-called long the so-called ES, Kyle? Were you at like 4,500? Sorry, 4,500.
Yeah, my break even's around 4,510.
45.10, it'll get back there.
Yeah.
45.10 is not within like, you know, an unreasonable so-called
Yeah. So
realm.
it's not
Tomorrow,
it's not
like I said,
bad.
yeah, it's not bad, but it ain't great. It wasn't. This
Yeah.
is not great either, you know. So yeah, I mean, this wasn't great either, but you know, it'll likely get back to that so-called level eventually. It's just a matter of time, like I said, and how much balls you have to actually hold on to this position. You know what I mean?
The other thing is my futures position expires next week. So.
Oh yeah. I know. Same here. I mean, you know, futures. We have to roll to the next so-called contractual expiration. Actually, yeah. Every futures position that's like. Is the next week the quad witching week? I'm trying to remember.
Yes,
it is.
It
right?
is.
It is. Okay, there you go. And that's the deal and everything. So yeah, just be aware of that though. But yeah, I mean, just a quick recap again though. We can just simply sell the so-called in the money broken wing butterflies to basically hedge our portfolio, and as long as, like I said, as long as your so-called sort of like right, you know, this should actually be a relatively easy so-called position for you to just simply put on. Since, like I said, the risk is relatively low for what potentially you could hypothetically hedge.
Try that out tomorrow.
Yeah, try it out. You know, again, hedges are just protection. You know, they're not made to make you money. they're made to protect your portfolio from like sustaining a massive like kick in the nuts, if you will.
At an all-time
so that's all it is
right now. So
yeah, I mean, it happens here and there, but hopefully you guys can like, you know, keep on continuing staying green from this point forward. Message me if you guys have any other questions regarding this, but I think it's pretty much straightforward. I mean, you know, you can do it at the money. If you want to do out of the money, like I said, you get a lot less premium for doing it. But you know, however you want to set this up is really solely up to you. You know, if you think that, you know, maybe it'll stay, you want protection from 4,500 and below, you can do this. You know, it really, like I said, solely up to you guys and everything as to what you guys want to do when it comes to hedging this. You can do by the way, also you can, I forgot to also mention too, you can also do this on the, obviously you can do this on the futures too, to basically as a hedge and whatnot though. 2 ES contracts equals 1 SPX basically. So if you want to proportionately, you know, have a hedge on SPX, you just simply do a double quantity of this, and this would basically be the equivalent of you hedging the so-called SPX itself. Futures have something known as span margining, so you sometimes may get a better buying power effect than you would the actual index. But you have to also be wary though, because span margining changes consistently. So as it approaches closer and closer towards the expiration, the buying power effect inflates greater. So span margining sometimes can help if you're doing something that's about like a month in advance and you're planning to basically close it in a few weeks type of deal. If you're holding it towards expiration, the buying power effect will probably be very, very much nearly basically, it should be basically close to the same as you basically doing this on the SPX alone already anyways. So just keep that in mind, you know, should you want to like, you know, use the futures instead of actually the physical underlyings themselves. Anything else, guys? I don't know. Any other random questions that you have that doesn't have to be necessarily about hedging, but anything,
So I
anything
have
that you
questions here. So
yeah, sure.
I have a lot of strangles on TQQQ right now, and then
TQQQ.
Yeah. So then
Okay.
to protect myself, should I be buying? If I buy, let's say a 90 strike, just so the amount of buying power stays at like 4,000 per contract.
Right.
And then if the IB goes up, the VIX goes up, it's not going to affect my margin, right?
The TQQQ. So if you have strangles, yes. If you basically obviously buy the wings, you'll basically protect yourself from having any of the so-called buying power like increase and inflate on you. That's the real reason to do it. What strikes are you on the TQQ and what expiration? Just so I can look at the position.
130 and 155.
For what, September?
Next week.
Next week?
Next week.
135, short the 135.
Short 130 and long the one, short the 155. 130 and 155.
130 and 155. 130, 155. Okay. So you're like this right now. What I would already start doing is start moving your put, like start rolling your put side a little bit more upwards, so that way you can kind of like neutralize your downside. It doesn't have to be that much though, but you know what though, you're at 130.
Yeah, I
right now.
just did that today. I rolled it from 125 to 130.
Oh, okay, yeah. Because like I said though, you want to try just roll it up a little bit. I would say I don't think you'll have a that much of a so-called issue with this. This position looks pretty okay though. Your call side looks like it. I don't really think like by next week it would probably get there, but I mean you just never know how it is. Another thing, I mean, if you do like the TQQQ itself and you are slightly bullish on it, or you might potentially be bullish on it though, you could hypothetically go into the straddle and you can just keep rolling the straddle and have this thing slowly try to grind its way to the center and then basically close the straddle out for a decent profit. And you can do that on a weekly basis too as well. That's something that I've been doing with like the ARC, for example, my ARC innovation. I purposely sold the 135 and like straddle for October and whatnot, thinking that basically and I rolled this already twice, so hence you can see that my break even is actually even more, is actually pulled around. I'm actually still profitable right here, but that's another move that you guys can also consider doing. Basically, is basically selling an in the money straddle on the put side. I don't like to sell in the money straddles on the call sides because of course the call has basically like unlimited risk. But presumably speaking though, if I'm already bullish on something, and I only do this also on things like ETFs or things that just don't go parabolic or has no chance of going parabolic, because if you start doing this on like things like meme stocks and whatnot though, you can get yourself into deep trouble. But things that you have like kind of a long-term bullish stance on, you could just simply sell an in the money a deep in the money strategy, just keep rolling and rolling and rolling, just keep collecting.
Buying the like the 90 put because it costs about $4,000 margin, because I have so many contracts. If it drops, I'm afraid that I'm gonna get margin call and drop.
Let me see. Okay, so let me see. Your idea, let's see, was to
buy the 90 put.
To buy the 90 put on this side, right? Because you're worried about the so-called the thing about the 90 put right now, because if this thing is expiring next week,
shouldn't have to worry.
I don't think you have to worry about this. It's because this is so far out of the money that, I mean, this thing has to, because here's the thing, like, oh, by the way, too, Chris, are you still with us? Just out of curiosity.
Yes.
Oh, you are.
Yes,
I just want to make sure. I forgot. Yeah, no, it's all good. It's all good. Yeah, I forgot to actually mention this to you last time when I basically was videoing you. But do you see these dotted lines right over here?
Yes.
Like the dotted lines on it. Do you know what those are? Or no, not really. Okay. These lines are known as the standard deviation lines. So this very first line right here is one standard deviation right over here. The second line right here afterwards is 2 standard deviations. So the first standard deviation is what basically is expected to stay within the so-called range of this about 68% of the time. Basically, is supposed to basically stay within the range. Now, when it goes to 2 standard deviations, it exponentially increases. I'm trying to remember. It's in the 90. I think it's in the 90 percentile. That basically, things are basically going to basically stay like out. It's very, very rare for it to basically pass basically 2 standard deviations of movement and everything. So back to you, David, because you're already past what for you to basically get in trouble here. You know, you can already see the standard deviation line is already here, and you're basically saying that basically Qs may actually pass this one standard deviation line, though. It's not likely, because once you're already past this, I almost want to consider this you're basically golden already. You know, so you don't have to worry. Now, if you start seeing it start to approach, then I would say, okay, well, you might want to might want to start consider, you know, buying one of these things as protection, though. But this put side is not something that I would actually worry about right now, because you're the so-called, it's at 148, your short call is at 155. That's something that might give you a little bit of not necessarily problems, but I mean, that's something that you might have to start paying attention to, because it is slowly approaching 155. But again, though, you're talking about like a week from now. It's within the expected move. How much premium did you collect so far total per contract? Do you know?
Between 300 to 500 per contract on both sides.
Do you know that? Do you know if you actually collected 500?
I have. Some I collected a little more because I rolled it.
Right, but I mean per contract, right? Not like as a whole. Per contract, you've at least rolled it and collected at least 500 for the same position, right?
Yeah.
Okay. So then now what you can do is, if you're worried about this, then you just do a Jade Lizard. You just buy the 160 right here, and then hence you've defined basically the risk to the upside. And I don't know, I can't see a profit and loss graph, but hypothetically speaking, you know, if you collected over so-called $5, and it's going to be hard to basically show it over here, but okay, let's just say that I sold, I don't know if that's going to show correctly, but will it show? Yeah, kind of like this. Basically, you have no risk to the upside if you decide to buy this one call. You won't get as much money, obviously, but basically, you know, if it stays still in between, you'll be still okay. You know, obviously your strikes are way like lower like this though. So basically you have this. So basically you're just protecting the upper side right now. So that's another idea that you can kind of consider if you're worried that the call size is going to be breached. If you already collected over $5 of premium, because the reason why I'm asking you about the $5 is because this is 5 points wide. So if you can collect at least at least the width of this minus whatever the premium of the so-called call credit spread. What is the premium call credit spread? 77 cents. So if you were at least collected $4, you know, in premium, then you should be profitable, even if TQQ were to just keep on going to the moon this way. You should be very like minorly profitable if you did that. So that's an idea. You know, double check your risk analysis graph just to make sure. But if you definitely did collect that, though, then a Jade Lizard was just very easy to just do and stuff, you know, without any so-called.
I figure I made enough on the put side. If I just close the call side even now, I lose 100 on the call side, but then I probably made
that's fine too. Yeah, that's fine too. It just depends on what you're expecting to do, whether or not you're going to hold it closer towards the expiration, or if you just want to call it quits now.
I'm just afraid of that margin thing, but like you said, if it starts to drop, then I buy the put, then I wouldn't have a problem.
Yeah, I mean, right now it's not likely to affect you that much, though. I'm talking about like people who basically start. So, for example, like you're beyond one standard deviation away from the put side, so that's not really that much of a worry. But let's just say, like, for example, that I was not like I was like within not necessarily the expected move. If I'm basically going to sell a put, for example. Let's just say I chose IBM to sell put on, right? If you want to just sell something similar, well, maybe IBM is not a bad, good so-called plan. But if I'm selling within the so-called standard deviation range, though, and then all of a sudden, like, you know, the market decides to basically, the volatility decides to go up, though, this 87 cents of credit that I collected, even though the things like at 137 could potentially be worth 3 or 4 times the amount of whatever I basically sold it for, just on the fact of implied volatility going higher. Now, of course, theta will eventually erode it downwards. It's just that, like, you know, some people basically use up. I hope you guys don't, but I mean, some people nearly use up all of their so-called options buying power. You know, around like, and they don't keep any kind of like what we call dry powder. They don't keep any cash on the side just in case the like, you know, the market basically, you know, gives you an opportunity to basically enter into more positions. That's when people get into a lot of trouble. But if you leave a good amount of so-called, you know, obviously buying power available, though, of course, your so-called margins are going to adjust and it's probably going to eat up a little bit more of the buying power, but you should not be in an extreme margin call. But I mean, I basically, back in the day, I sold a hell of a lot of puts, you know, before the March crash and whatnot, though. And yeah, unfortunately, I was margin called, even though I didn't have that much dry powder. To be quite honest with you, I had like less than 10% dry powder. I like to keep around at least 20% of like something in cash, at least, though. Once basically tomorrow reopens, so this thing should be basically all good, you know, to go and stuff. But you know, like I said.
Well, yeah. One other little question I have is because I have a lot of CTHVs now, so that's another thing. So when if the VIX and
yeah,
IV
that's the yeah. So those, like I said though, those generally speaking don't get the good news about those is that generally speaking those don't get affected too much though, since you're so far out of money with those, you know, and that's the beauty of that. When you have like the crouching theta trades and whatnot, you know, you really don't have to worry too much about the so-called volatility expanding as much, because first of all, like also one thing to kind of also realize too is that when you're doing a CTHV trade, like on Win, for example, when you look at how the volatility is outwards, usually as the further out you go into time, you know, usually the volatility usually expands greater and all. November 19th seems to be like the highest volatility time though. So you're not selling at the lowest so-called volatility part. I think this is probably not really the best example though. Let's see how's Tesla doing. Yeah, I mean you're basically at wow, look at this. Why is this thing at 154?
Oh shit.
Did you guys notice that? Holy.
What?
There's a 154 in volatility for some weird reason on the 16th of September.
Time to get some more Teslas.
I was gonna say, yeah, but to be quite honest with you, you can't go that low of a strike though. You remember the time when I introduced this trade to you and you're able to sell at 250s for like freaking like almost like, you know, 2800s? Like you're not gonna be able to do 250s with 372 days. You would have to go, geez, you would have to go like maybe like 560s. Yeah, around 560s, maybe 550. Or 540, no. Yeah, like around 550. So you're going to be definitely going to be a lot closer to the so-called money if you decide to do it in this high. I don't get this. I don't know what the deal is with this actually, to be quite honest with you. So that I have no clue on. But I mean, you know, presumably speaking, if you're gonna do the CTHV trades and whatnot, though, you're so relatively far out of the money that you don't really have to worry too much, because the ones that are in a close proximity of the so-called standard deviation are the ones that are going to be hit the most, right? So let's just look at Tesla. So let's just say here, if you're going to sell the 450s, right? That's pretty much what this position would be for CTHV. If you go to, let's just say next week, and we look at the 450 strike, you are way like, you know, out of the so-called range, you know, of worrying about like, you know, the so-called volatility expanding on this, you know what I mean, at the 450 strike. So that's why you don't have to worry about the so-called volatility expanding when you're doing CTHV. Volatility expanding actually affects the ones that are basically expiring the closest in the most like soonest like time. So that's what you have to always keep in mind when you're doing this type of trades though. CTHV is actually, to be quite honest with you, is probably one of the best methods to just park your money until the coast is clear, you know. And there's been a lot of there's been a lot of different underlines that you could do the crouching theta. I hope you guys found some others, you know, out there too. I mean,
Coinbase.
you have to do you have to do some hunting around, but I mean, they do exist and everything, and it's probably one of, like I said, about one of the best spots to park your money for the time being until you know.
Apple has been.
I do struggle to get 30% profit. A lot of them I just close at 20% profit.
That's fine. Whatever. You don't have to do 30%. It's just that that's what the professor does. You know, he basically holds it till about 30%. Which again, do you want to do it at 20%? That's great too. And actually, like I said though, when you actually do trades like that, it's pretty surprising how quick it actually does decay, even though the thing actually is far from, like, you know, the expiration date and whatnot. So that's, yeah, I mean, CTHVs, like I said, great trades to just to park your money. Will it make you a lot of money in the shorter term though? Not as much though, but it's not bad to have a good position in, especially if you have money that you just don't know what the hell you're going to do with. But yeah, I mean, nowadays, you know, how the market is reacting though, just get as diverse as possible. That's the best way to basically describe it. You know, make sure that you have good diversity in everything. You know, just things that are least correlated to the markets and all. If you want to, like, you know, like I said, trade a little bit of futures too, to just try to, like, you know, mitigate any of the so-called exposure that's directly associated with the market. So, you know, gold. Recently, natural gas went like the moon. I don't even know what the hell, man. Like, natural gas is like an astronomical high nowadays. But like, yeah, I do gold, do some, like, you know, crude oil, doing a lot of agriculture like soybeans and wheat and stuff. I caught a nice run up in wheat and then also sold out of it too. And actually right now, wheat for some odd reason is actually at a very, very low price right now though. So I might actually get into like some wheat futures, like, you know, next week. Actually, maybe tomorrow when it opens, I'll just put a little bit of I'll just long some wheat and probably put like I don't usually do too much of so-called stop losses on these. I basically have a directional bias. I'm willing to basically risk about maybe $200 though. After I enter the position, put a $200 stop loss, let the thing run. If the thing starts to run over $100, you know, in profit, I'll just lock in $100 and just basically let the thing like run as far as it wants to go. So yeah. Okay, so in any case though, yeah, let me know if there's any other questions for you guys though. If you guys need me to, like, you know, help you put this trade on, if it looks a little bit complex to you though, let me know too though. I'm willing to, you know, help you out too. Another thing that you can do is, I already showed you guys how to do the zebra, but you could zebra some of the so-called, so right now I have a IWM, which is the Russells. I have a zebra on it though. I have an October 1st zebra that I think I paid about $1,000 for, right? I bought two of the so-called 70 deltas and sold one of the so-called 50 deltas. And when you look at the curve right here, you know, I have basically total downside protection. It's a little bit green right now, but I mean, again, I'm basically risking about $1,300 just to kind of protect the so-called position a little bit, all the way up until basically the 1st of October. Again, hopefully, if this thing goes up and basically gets breached, though, the rest of my portfolio is going to make up this so-called $1,300 of loss. But another idea, like I said, you can use zebras on the SPY, triple Qs, or the IWM if you want to also hedge as well. Though that's more of a hedge where you want to kind of, it's not as active, meaning this is kind of like a passive type of hedge. The thing about zebras though is that if you're already at a 50% loss, meaning like it's just not going your way, you should already close it. This is something that you don't want to be really, because there's no reason for you to, you know, eat this entire, you know, loss and hold it all the way to expiration. You know, if you're going to do a zebra, just do it up until a 50% loss and then close it and figure out what you want to do afterwards, or, you know, or if you want to reposition another zebra at a different strike, that's fine too. But, you know, hopefully this is not something you're going to hold to expiration. If this thing loses about 50% of its value, you know, because the Russell decides to keep going higher and higher, I'll just close that 50% loss, move on and stuff, and that's basically it. So
great, thank you, Rob.
no problem. Okay. So